household debt almost double disposable income. The ratio of household debt to disposable income is expected to reach 135.6% in 2022 to 2023. In 2014 to 15, both secured and unsecured debt increased, while low-income growth contributed towards a rising level of household debt to disposable income. The inflation rate had been decreasingly gradually over the 4 years through 2015 to 16, briefly falling below 0% on 2 occasions during 2015, far below the target rate of 2% as the government sought to stimulate the economy. The stamp duty holiday aimed at stimulating the economy after the coronavirus outbreak, which lasted to September 2021, further increased demand to mortgages. However, in 2016 to 17, inflation began to pick up as low value of the pound increased and the cost of imports. Real disposable income started to slowly increase from 2014 to 15. After several years of poor performance, in recent years consumers have been cautious overspending due to uncertainty over the state of the economy. Furthermore, government-backed housing schemes such as funding for lending scheme and help to buy increased household demand for mortgages. Low interest rates and government backing have also helped to reduce rates on borrowing, not just for mortgages but for personal loans and credit cards as well. Over 2015 to 16, both secured and unsecured debt increased. However, as disposable income also increased, the ratio of household debt to disposable remained static. However, a greater increase in unsecured debt borrowing on credit cards and loans, coupled with weaker growth in disposable income levels, increased the ratio during 2017 to 18, with the ratio of household debt to disposable income rising by 1.8 percentage points. The ratio of household debt to disposable income was significantly affected by the COVID-19 or coronavirus pandemic in 2020 to 21, as the virus outbreak halted economic activity and led to increased use of unsecured debt. More households resorted to the use of available credit facilities. For a large proportion of households, lockdown measures led to enforced halt to spending, with household paying off a significant amount of debt. However, a large proportion of households also experienced cuts in income, job losses, or being furloughed, which has encouraged more people to take on debt. Overall, the rate of household debt has slowed slightly, with many households prioritizing essential spending. Due to the crisis, many institutions suspended lending, which has affected the ratio of household debt. As a result, the ratio of household debt to disposable income increased by 1.8% in 2020 to 21. As a result, however, these pressures eased during 2021 to 22, as the UK's level of household debt to disposable income fell by 0.2%, as the successful COVID-19 vaccine rollout allowed for a reopening of the global and domestic economy, with employees returning to work and full salaries resumed, and a steady wind down of a furlough scheme. This is because the UK economy is expected to face a significant rise in inflation and a subsequent cost of living crisis. For instance, the ONS announced on 18 May 2022 that the UK consumer price inflation had reached 9% in April 2022, surpassing the peaks of the early 1990s recession that consisted of sky-high interest rates and widespread mortgage defaults. Soaring energy bills being the biggest inflation driver of inflation, the UK 12-month CPI inflation rate rose to 9.6% in October 2022, and the Bank of England has suggested it could rise above the 10% mark during the calendar year, driven in large part by supply-side factors. Specifically, these supply-side factors relate to supply chain disruption, caused by both the Russia-Ukraine conflict and ensuing pandemic-induced market difficulties, and resultant energy commodity price volatility and issue in goods trade. Consequently, the ratio of household debt to disposable income is projected to rise by 0.5% in 2022 to 23, to reach 135.6%. Hence, the ratio of household debt to disposable income is estimated to rise by 0.1 percentage points over the 5 years through 2022 to 23. Financial institutions use debt-to-income ratio to find out how balanced your budget is and to assess your credit worthiness. Before extending your credit or issuing you a loan, lenders want to be comfortable that you're generating enough income to service all your debts. Keeping your ratio down makes you a better candidate for both revolving credit, such as credit cards, and non-revolving credit, like loans. Here's how debt-to-income ratio works and why monitoring and managing your ratio is a smart strategy for better money management. How to calculate your debt-to-income ratio. Number 1. Add up your monthly debt payments, rent or mortgages payments, student loans, auto loans, and your monthly minimum credit card payments. Number 2. Find your gross monthly income, your monthly income before taxes. Number 3. Debt-to-income ratio equals your monthly debt payments divided by your gross monthly income. Here's an example. You pay $1,900 a month for your rent or mortgage, $400 for your car loan, $100 in student loans, and $200 in credit card payments, bringing your total monthly debt to $2,600. Your gross monthly income is $5,500. Your debt-to-income ratio is $2,600 over $5,500 or 47%. What do lenders consider a good debt-to-income ratio? A general rule of thumb is to keep your overall debt-to-income ratio at or below 43%. This is seen as a wise target because it's the maximum debt-to-income ratio at which you're eligible for a qualified mortgage, a type of home loan designed to be stable and borrower-friendly. Debt-to-income ratio of 36% or less. With a DTI ratio of 36% or less, you probably have a healthy amount of income each month to put towards investments or savings. Most lenders will see you as a safe bet to afford monthly payments for a new loan or line of credit. Debt-to-income ratio of 36% to 41%. DTIs between 36% and 41% suggest that you have manageable levels of debt in relation to your income. However, larger loans or loans with strict lenders may like to see you pay down some of this debt to reduce your DTI ratio before you earn their approval. Debt-to-income ratio of 42% to 49%. DTIs between 42% and 49% suggest you're nearing unmanageable levels of debt relative to your income. Lenders may not be convinced that you will be able to meet payments for another line of credit. Debt-to-income ratio of 50% or more. All DTI levels of 50% and higher, you could be seen as someone who struggles to regularly meet all debt obligations. Lender might need to see you either reduce your debt or increase your income before they're comfortable providing you with a loan or line of credit. Does your debt-to-income ratio affect your credit score? The short answer is no. Credit reporting agencies don't collect consumers' wage data, so debt-to-income ratio won't appear on your credit report. Credit reporting agencies are more interested in your debt history than your income history. Although your credit score isn't directly impacted by your debt-to-income ratio, lenders or credit issuers will likely request your income when you submit an application. Just as your credit score will be one factor in their application review process, your debt-to-income ratio will also be taken into account. For this reason, maintaining a healthy debt-to-income ratio can be just as important for your loan or credit eligibility as having a good credit score. What happens if my debt-to-income ratio is too high? If your debt-to-income ratio is higher than the widely accepted standard of 43%, your financial life can be affected in multiple ways, none of them positive. Less flexibility in your budget. If a significant portion of your income is going towards paying off debt, you have less left over to save, invest, or spend. Limited eligibility for home loans. A debt-to-income ratio over 43% may prevent you from getting a qualified mortgage, possibly limiting you to approval for home loans that are more restrictive or expensive. Less favorable terms when you borrow or seek credit. If you have a high debt-to-income ratio, you will be seen as more risky borrowing prospect. When lenders approve loans or credit for risky borrowers, they may assign higher interest rates, steeper penalties for missed or late payments, and stricter terms. Why your debt-to-income ratio matters? Keeping your DTI ratio is a reasonable level signals that you're a responsible manager of your debt, which can improve your eligibility for financial products. The DTI ratio also provides you with a good snapshot of your current financial health. If it's below 35%, you're in a good position to take on new debt and pay it off with regularity. But when it's over 50%, you should try to reduce the number of debt obligations by either working to pay off credit cards, find more affordable home, or refinancing your current loans, or find ways to generate more income. When your DTI falls between 35% and 50%, you'll usually be eligible for some approvals. Even so, your financing terms on lines of credit will be better if you hit the premium level of sub 35% debt to income.